Businesses do not exist in a vacuum. The performance of any one business must be compared to its competitors or even its industry, which provides valuable context. Now, there are many ways to do this, but here on The Quality Investor, we want to simplify the process. If there's a way to encompass the fundamentals of a business in a single number, we're going to attempt it. And one critical aspect of any business is its ability to grow. Welcome to The Quality Investor. A few weeks ago, I did a video about my process for quantifying an economic moat. The video is linked in the description, but it is a way to compress the components of a business's fundamentals into a score to compare against its competitors. I also demonstrated a correlation of that score to historical returns. However, in that demonstration, I included a component of growth in the total score. Today, I want to discuss the details of that growth component. This is a follow-up to that video. Growth is how businesses survive. Every management team discusses it, Wall Street is obsessed with it, and it really is a precursor to any meaningful appreciation on our investments. Growth is achieved with reinvestment back into the business. Of course, there are other factors like overall market growth, industry maturity, etc. But reinvestment leads to growth. On my last video, also linked below, I discussed the relationship between growth and ROIC. Basically, return on invested capital multiplied by reinvestment rate equals the expected growth. Going deeper, high ROIC businesses can reinvest less of their operating earnings back into the business and still achieve higher free cash flow. Longtime viewers of this channel know my fondness for growing free cash flow. Before continuing, please remember to like this video below and subscribe to the channel so you can stay on top of all the quality businesses in the market. So, in devising a scoring metric to measure growth, I looked at a few different elements of growth. The components are revenue growth, gross margin expansion, operating margin expansion, earnings per share growth, share outstanding reduction, and free cash flow growth. I don't treat each of these equally, however. I assigned a weight to each component to come up with my total growth score. I arrived at these weights through trial and error. Essentially, there needs to be a positive correlation between growth and return. The highest scoring businesses should have the highest return. Also, the more historical data points included should lead to a more positive correlation. So we'll look at these results in a second. Before that, I want to discuss the weighting. I assigned a 25% weight to free cash flow growth. Free cash flow is what is left to investors, and in my view, it's the most important piece to share price return. I assigned a 20% weight to revenue, gross margin expansion, and operating margin expansion. Revenue, of course, drives the rest of the income statement. Falling revenue year after year is bad, but just as important is margin expansion. A business that expands its margins has certain qualities. It could be pricing power in the market, operating leverage, efficient manufacturing processes, disciplined management, but it also leads to higher return on invested capital, essentially higher profit return for each dollar invested. Then I assigned a 10% weight to earnings per share growth and a 5% weight to shares outstanding reduction. Earnings per share is a metric that is most prone to manipulation by management, and it can also include many items not related to core operations, but it still needs to grow. Share buybacks reduce shares outstanding. It is a form of capital return to investors in that it increases the per share amounts for each investor. But I also believe it is the least value add and therefore only worth a 5% weight. In other words, reducing shares does not increase the intrinsic value of a business, but it does provide a small benefit to investors. And with that, let's dive into those scores. So we're looking at a few visuals here of my growth score. This is going to be for the S&P 500 companies. And right now we're looking at a 3-year period, meaning I'm using the 3-year growth rates, the compound annual growth rates for each of the components. We can see revenue, gross margin expansion, operating margin expansion, earnings per share, shares outstanding reduction, and free cash flow. And then all of that together gives us our growth score. I gave each business a score of 1 through 5 for each component. And that's based on these percentiles over here. So for revenue growth, the 80th percentile is 22%, meaning any business with over a 22% compound annual growth rate for revenue has a 5. And for any business with less than 0% revenue growth, basically negative revenue growth, they receive a score of 1. So between 14% and 22% is a score of 4. Between 7.5% and 14% is a score of 3. And between 0% and 7.5% is a score of 2. Going through each component here, you can see what my percentiles are for each one. So for gross margin percent, for example, if a company has expanded its gross margin by 4% per year over the last 3 years, it received a score of 5. Businesses where the gross margin is actually shrinking at over 1% per year or margin contraction, they receive a score of 1. Operating margin, anything where they're expanding their operating margin by 12% or more a year. Now, this isn't above a 12% operating margin. That means they're growing their operating margin by 12% per year. So a 30% operating margin business in 1 year becomes a 34% operating margin business the next year. And if their score is contracting by more than 3% per year, they receive a score of 1. Earnings per share growth. Over a 30% per year earnings per share growth gives a score of 5. And if the business is reducing their shares outstanding by 4.5% per year, so their shares outstanding are decreasing by 4.5% per year, they get a score of 5. And if their shares are increasing by 2% or more per year, they get a score of 1. And finally, for free cash flow, if they're growing their free cash flow by more than 23.5% per year, they get a score of 5. If their free cash flow is declining, they get a score of 1. And then down here, I'm ranking each business by their growth for whatever component is selected. In this case, we're looking at the free cash flow per share. Right now, Citizens Financial Group, Fifth Third Bank, ConocoPhillips, these businesses are growing their free cash flow by quite a bit. However, we're only looking at this on a 3-year basis, and it could be skewed onto different factors. If we take a look over here, we can see the top businesses on a 3-year basis right now are mostly in the energy industry. It's because the energy industry has been in its upcycle the last 3 years. It's a very cyclical industry. And take a quick look at this chart down here. This is the 3-year annualized return versus the 3-year rolling growth score by each company. You see the line is positively correlated, but it is a slight increase over time. This is what I was saying earlier about adding more data points. It's actually more useful to look at this over a broader time frame because then you're accounting for that cyclicality that's in a lot of industries. Now we're looking at the 5-year growth score. And you can see in this chart that line is a little bit more positively correlated. Personally, I like to look at at least a 5-year basis as my starting point. So looking at that now, we can see the score is a little bit more normalized for every industry across the board. Of course, this Enphase Energy is still at the highest at a 4.8 score, but that's followed by Chipotle, which has been on an absolute tear over the last 5 years in terms of share price appreciation. Their growth score is reflecting that. And number 9 on the growth list, of course, is NVIDIA. NVIDIA has been an absolute tear at a 4.5 growth score. But you can see here, over the last 5 years, they have a 102.5% compound annual return for their share price. Just incredible growth that they're on. And of course, looking at it on a 10-year basis, we can see it really is the best companies that are leading the way here. Amazon is at number 1 with a 4.85 growth score. NVIDIA now is number 5 with a 4.65 growth score. Netflix, of course, has been one of the best growing businesses over the last 10 years. And you have a few other semiconductor giants in here like Lam Research, Broadcom, Supermicro Computer. But I think here on the chart, we're definitely seeing a much more accurate reflection of the growth score over the last 10 years. NVIDIA here has a 74% compound annual return over the last 10 years. And Builder's First Source, the second on my list here, has also a return of 34.8% compounded annually. Amazon, the number 1 score, has a 27% compound annual growth rate the last 10 years. So you can see here, the companies with over that 4%, only one of them is down near 0. And that's Insight Biotechnology. Biotechnology can be a very boom or bust industry as well. But if you have that high growth, you're going to have high share price appreciation. And that's what we're seeing here on this chart. And it looks like the low end threshold is about a 2.5. If you're about a 2.5 or above on your growth score, you're going to get at least the market return, or at least you should expect the market return. Of course, there are going to be outliers like there is with any other type of system. I mean, ExxonMobil here has a 2.7, but only a 1% compound annual return over the last 10 years. Down here, Warner Brothers has a 2.55 score and a negative 14.8% compounded annual return over the last 10 years. So you're going to have your outliers, but for the most part, if you're above that 2.5 point threshold, you should expect some returns. Ideally though, we want to focus on anything above a 3 on the quality investor. Here I'm filtering it by one of my favorite sectors, technology. You see that very strong correlation here in the chart below. You can see it's dominated by world-class companies. NVIDIA, Lam Research, Broadcom, ServiceNow, Fortinet, Palo Alto Networks. But what I want to start doing with this growth score is, in conjunction with my economic moat score, start really leveraging it when I'm doing analysis on businesses going forward. I want to break down the components of each business, look at how they're scoring on each component, and while we quantify that, also really dive into the qualitative aspects that are driving revenue growth or driving margin expansion. Now, I was asked about the formula that I'm using here, and it's pretty straightforward. Essentially, I already said 1 through 5 is based on the percentiles of each component. And then I have a weighting for each component, which gives us the total growth score. So 5, of course, for revenue growth is going to be because they're above a 22% compound annual revenue growth rate. You can see ServiceNow has a 36% compound annual growth rate the last 10 years. They have a 5 score. Broadcom has expanded their gross margin by 3.8% on a compound annual basis. Broadcom has a 4. It's in between the 1.25% and the 4%. So that's how I arrive at each number for each component. And then the weight is, again, 20% for revenue, 20% for both gross margin and operating margin, 10% for earnings per share, 5% for shares outstanding reduction, and then a 25% weight for free cash flow. And then I use that weighted average to get the growth score. And here's the economic moat score that I showed in that video a while back. I use the same exact process. 1 through 5 is based on the percentiles over here. And then I weight each component to get to a weighted average for the economic moat score. So the weights for each of these, and this is an average gross margin over the last 10 years, is 10% for gross margin, 5% for SG&A average over the last 10 years, 7.5% for interest expense margin. This is your interest expense over your operating income, and then the average of that margin over the last 10 years. The CapEx expense margin, or CapEx over net income, and that average over the last 10 years, is a 12.5% weight. Free cash flow conversion average, or how much free cash flow for every dollar of net income, free cash flow over net income, is 17.5% weight. ROIC is a 22.5% weight, and ROCE, return on capital employed, is a 25% weight. And then ultimately, I tie both of those together. I combine the growth of the economic moat score to get a final number here, 1 through 5, and then I have that correlated with my share price return. So you can see here the top score over the last 10 years, growth and economic moat score combined, is a 4.56. And of course, that business is NVIDIA. And with that 74% compound annual growth return over the last 10 years, they have the highest score, they have the highest return. And you can see here, there's some of the top businesses. This is again the technology sector. So this is Lam Research, Fortinet, Arista Networks, Paycom, Applied Materials, Adobe. And you can see that very strong correlation here when you combine both of those scores together. And like I was saying, we want to see above a 3 for that total score. Virtually every S&P 500 business in the technology sector has a plus 10% return with above a 3 score. The only 3 outliers here are F5, Cisco, and Skyworks, a semiconductor firm. And looking at the entire S&P 500, again, a very strong correlation between that score and the share price return. NVIDIA, of course, in the last 10 years is the best and is still dominated by the tech industry. Lam, Fortinet, Arista, Paycom, all still in the top 5. Amazon is considered a consumer cyclical in this categorization, but strong argument can be made their technology, Applied Materials, Adobe, and then some non-tech firms like Old Dominion, Freightline, Builders First Source, Nucor start dotting the top 18 or so here. So I wanted to give a breakdown about how I came up with these scores and how I'll be using them going forward. I think I'm going to be incorporating these a lot more into my analysis, and it's going to really help me, again, dive into businesses I think are worth investing in. So I'd love to hear all your feedback about the scoring system here and what you think I'm missing. What could I do better in terms of trying to quantify the fundamentals of a quality business? Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.